The U.S. economy faces new policies, global uncertainty, and a changing rate outlook. As yields climb and recession fears linger, how can investors position for opportunity? We're going to dive right into that conversation right here on UBS Trending. Hi, everyone, and thank you so much for joining us. I'm Anthony Pastore, and this is UBS Trending. I am thrilled to be joined once again by my Chief Investment Office colleague, Leslie Falconio, to break down the latest on what's going on within the fixed income markets. Leslie, lots to get to. Good to have you here. I just thought maybe we could start. There's been a lot of conversation. There's this sort of shifting narrative, right? It's tariffs, it's potential tax cuts, and a lot of talk, yet not really any action just yet on potential deregulation. So because of that, there's been a lot of volatility. And as you look at the yield curve, the back end has really changed. Has that changed your outlook for Treasury yields?
You know, it hasn't, Anthony. One of the things that we did heading into this year, and actually we started this, I would say, in the second half of 2024, was that our expectation with the yield curve would steepen, right? And it would steepen with, more than likely short end yields coming down. But even if you weren't bullish, you were bearish, you thought interest rates would rise. In either direction, the steepening of the yield curve would have that sort of back end underperform. So we really guide investors to stay away from the long end of the yield curve because of potential that shifting in dialogue, the rising of the deficit, and just the fact that the fixed income market's forward looking, you're going to have a reaction, even though you don't know exactly what some of these implementations will be. As we've seen, the market reacts just from chatter. So one of the things that we did was say, okay, stay away from the back end yield curve, stick with that intermediate part of the curve around that 5-year. So we came into the year long 5-year treasuries, but during that April volatility, we actually went a little bit more neutral when that 5-year got to 3.7%. And since that time, we've kind of been waiting and watching a little bit and waiting for that entry point to actually extend interest rate risk. As you know, Anthony, we got to a 463 and 10-year yields. The 30-year got to a 515. These levels are like 2023 levels, if not higher. So I do think that although the market and us as well was anticipating the shift in narrative, it's number one, come a little bit more sooner than expected. But number two, I think it's important to remember when the de-escalation occurred after some of the shifts in tariff policies between the US and China, you removed that left tail risk, right? We saw interest rates rise because of that removal of left tail, because we have second quarter, GDP running about at 2.3%. And most importantly, all that widening that we saw in credit, on that, pre and post liberation data all come back. So, the market was actually getting, a little bit, I would say, tighter in spread, a little bit more comfortable with the outlook in terms of not having a recession, prior to actually the dialogue in terms of what we're seeing with the current bill, and that's just sort of exacerbated that.
So, and speaking of Liberation Day, another thing that we saw was that risk assets really came into the spotlight yet again. Is this the time for investors to be thinking about increasing their profile to more risky assets here?
We've kept somewhat diversified in the sense that we still like the high quality overall, right? We still like agency MBS. We still like investment grade corporates. We think they're getting very good yield and compounding income from those sectors. And again, our view is not that we have a recession. We're more into growth starts to slow at about 1.5% by the end of the year. So we still are in the high quality, but we also have an overlay in senior loans. And there's no question that during the volatility that we saw in April, the loan market actually, faced a lot of performance headwinds. I mean, mainly because that recession probability was becoming higher. That's come all the way back, and the same thing with high yield. But we like the loan area because our expectation is that the Fed is not going to, cut. I mean, in April they had 105 basis points of cuts in 2025. Now they're down to 44. So it's really had a shift. So we do think that the Fed cuts this year, between 50 and 75 basis points, but we're going to have that higher for longer. So we do like the loan market. So we have some floating rate and some higher quality in that intermediate 5 to 7 year part of the curve.
I want to ask you about agency mortgage-backed securities because for a long time, CIO and you have had an attractive viewpoint of agency MBS, considering where their spreads are so wide, and it's been historically a good spot. But we are seeing mortgage rates, 30-year mortgage rates, tick back up to that 7% level. And also, you've had some recent tweets from the president talking about privatizing Fannie and Freddie Mac. Does that give you any pause? Do you still see attractive valuations in MBS right now?
Look, there's no question when it comes to the level that the MBS, went to in terms of current coupon in, say, like the 160 areas versus, treasuries, those are attractive levels. The volatility that we've seen in the rates market has been a headwind to performance. The fact that, a lot of investment managers are actually long the sectors and banks are getting a little bit full, there's no question has been a bit of a headwind. But we still think the sector offers a lot of value here. And to your point, Anthony, I mean, besides the volatility, these tweets that we've seen, whether regarding the potential privatization of the GSEs, and today actually we had another one saying that they may still keep part of this government guarantee with them. We saw spreads tighten in. Now, it's not our view that the privatization is necessarily 100% certainty. We just think there are bigger fish to fry than the Fannie and Freddie. We've heard this before. So we do think that overall the sector is attractive, but there's no question that given the level of uncertainty that we still have, for the next several months, it might take some time for these spreads to really truly start to compress. But in the meantime, you're earning a 5.90 yield for current coupon. It's incredibly liquid sector. We don't, if there's, zero to minimal credit risk within them. So we do like agency MBS, but we recognize that there's going to be a little bit of volatility ahead. But when it comes to relative value, that's really the sector you should be in.
Excellent, Leslie. Thank you. I want to also ask you because we've been positioned in that intermediate part of the curve, which is technically between 2s and 10s. And for a while, CIO had an attractive view on that 5-year part, the belly of the curve. But as you mentioned before, we've seen rates on the long end tick significantly higher back to 2023 levels. When should investors be extending their risk out, like duration-wise? What's the view here? Where do you think we should be putting our money to work right now on the curve?
Yeah, there's been this sort of misconception, particularly when, people talk about the correlation between equity and fixed income, which really is, a big driver in terms of whether it's term premium or the performance of risk assets. But if you look at, the times when the equity market was underperforming and things like the 5-year treasury, which we held, the 5-year treasury actually has returned fairly nicely this year overall. And the 10-year is actually positive total return. It's just actually the 30-year that has been the drag. And you can see this from this chart that's on the screen right now. I mean, that 30-year total return has been negative, but the 5 and the 10-year have actually been quite positive. Our preference has been towards that 5-year. The 30-year is something that we probably won't, dip our toe into simply because not a tremendous amount of liquidity, a lot of volatility. But to go from, say, the 5-year to a 10-year is something that we would consider, but we want to wait to see if we get to that 475 or maybe even the 480 level that was close to the year-to-date high. I mean, we're not quite. I mean, although the market is, in our opinion, a bit on the hawkish side right now, given the amount of cuts they've priced out, we still have a lot of uncertainty, in the next couple months. So while our expectation and intention is to buy that dip, we might wait a little bit till we get to say anywhere between say 465 and 480, we think would be a nice level to start to extend. But for right now, we're going to sort of wait and see. We still like the intermediate as the point on the curve, particularly given the fact the market's hawkish. But we do think there is a potential at some point this year to actually extend your interest rate risk at a bit higher yield levels, even though our end of year is still around the 4 and 4.25% levels, because we do think in the second half is when you're going to see that downward trending growth.
Right, and those end of the year yields that you just mentioned, Leslie, that's also taking into consideration, I assume, the fact that CIO expects the Fed will start cutting rates in December, and we might see 3 separate 25 basis point cuts before the end of the year, right?
It's between 2 and 3, probably starting in September, that we have that cut starting. We had 3, now we're between 2 and 3, but we do anticipate they're going to cut this year. And more importantly, I think when the market starts to see, and it'll react to this temporary rise in inflation that we're going to see due to tariffs, and that starts to trend lower, right? Particularly since this escalation has de-escalated, right? So the inflation impact will not be as great as it was, say, in the beginning of April. that's when we'll really start to see some momentum in yields coming down.
Right. And I imagine also we'll have to keep a lot of our investors and clients calm, as we might see some knee-jerk reactions to those initial inflation numbers. But as you said, it'll be an initial kind of thrust higher because of the tariffs, and hopefully start to level out. Anyway, lots for us to do over the next few months, Leslie. Always great to have you join the show. Good to see you.
Thanks very much.
Thanks again, Leslie Falconio from the Chief Investment Office. So for more information, you can visit our website. That's the Insights website at ubs.com/views. Lots of great content up there from Leslie and the rest of the Chief Investment Office. Plus, you can follow UBS on social media. We're on LinkedIn, Facebook, and Instagram. Also, check out our dedicated studios channel on Instagram at UBS Trending. Lots of great content there. And as always, if you have any questions or would like to continue this conversation, make sure that you are doing so with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.